with Leon and few other members of the Profit Makers community. We are here to talk about NIO and potential ways to hedge it. So, NIO has been a very highly discussed trade in different communities. So we're here to now just go beyond just the trade itself and look for ways to hedge it or try to salvage profit out of it. So let's go ahead and discuss our original positions in it, and then go ahead and share potential hedges. So I think we have Leon, we have a few other folks here. So let's get started. Who wanted to go? And Escher, you there?
Yeah. So I'll share with you my trade that I've got right now on NIO. So let me just share my. It says you cannot start screen share while the other participant is sharing.
Give it a try one more time. It should work.
Yep. Okay. So can you see my screen?
Yes.
Yeah, we see it.
Okay. So I bought NIO back in October. You can see the first trade there on is that average price. I bought 2,000 shares for $27. So obviously the price has gone up and to $41, and I've got basically 29,000. I haven't sold any of those shares. I've got 29,000 in open P&L. Now, obviously the last few weeks have been pretty volatile. So I've put on a put. I put on a December 31st, 2020, $45 strike price put. And you can see I didn't know what I was doing. Like you can see I've closed 240. I've been buying and selling, and I've made $3,100, but it hasn't been enough to hedge me on the way down as much. And also, if you look, it's costed me $59,000 to put on this put. And so I don't really know if this is the best way to hedge myself. I guess I'm trying to figure out what I should do this week to basically hedge that 29,000, and if there's a way that's cheaper than putting $60,000 on the line as a put. It's kind of where I'm at right now. Is I don't think I need to spend $59,000 here to protect myself on that position.
Good point. So first and foremost, I am of the opinion that you own the shares, right? 2,000 outright.
Yeah.
If you have no other tax implication issues or anything like that, I would convert those first. Okay. I would convert those to deep in the money calls, like maybe in leaps, like really far out to 2022 or 2023. The reason I say that is because that leap itself is a hedge. Okay. And what I mean by that is you'll be replacing the shares, like 2,000 shares, with 20 contracts of a leap, in the money leap contract that is in 2022, 2023, which means that for every dollar it goes up, you make money. And for every dollar it goes down, like what I mean by make money, you'll close to $1 on that. For every dollar it goes down, you're going to lose 90 cents, 80 cents, 70 cents. So as you're going down, you're not losing much on your ROI pretty much. So it's kind of like, right now you're on a steep slope. Actually, for every dollar it'll go down, you're going to lose $1 because it's shares, right? Pretty much. And in the contract space, you wouldn't lose dollar for dollar. Does that make sense, or did I lose you there in that?
No, that makes sense. I think for me, I like owning NIO because I'm in it for the long run, and I like seeing that average cost price of $27. And I think in 5-6 years, I intend to look back and see that, like with contracts, I don't own it. I have the right to own, and so I see this is more of a long-term play for me as well.
Okay. Yes. So that's why I'm saying that. So that's kind of like the illusion game, illusion/emotional game that we're getting into. The reason I say contracts are better is your intention to hold NIO long term is not that they're going to give you the company shares, like they're not going to send you a certificate in the mail. The reason you're owning it is so that you can monetize on the growth, right? Story. that's probably one of the reasons you own it. If your intention is just to hold the shares just because of the name and the price, like at what you're owning, then I agree with you. But if you're doing it for the growth story, the contracts that I'm trying to vocalize is also a long-term story. So you're never
Okay.
like, when we even reach a point in the future, like 2023, we're going to do a trade in. We're going to trade in with even 3 years out contract. So you're going to be in the long-term story as well. It's just that the contract has more favorable terms, and it's very hard for people to digest that, especially
So
the beginning.
just my question on that is, so 3 years out, if I exercise those leaps, will my ACB, like average cost base, be at that price, or will it be at the price that I buy it today?
It will be much lower. So here's the thing: is what I'm saying is you're going to trade it in. So you're going to take the 2,000. You're going to book the profit on that, which is 29,000, whatever we see on the screen today, and then you're going to start over in making a larger gain. Now this is only applicable if you don't have, you're not worried about the tax consequences of realizing the gain.
Yeah, this is in a tax account. So if I realize that, I will have to pay taxes on that. So ideally,
You want to
this is
avoid
like
that.
Pardon?
Are you saying you want to try to avoid the taxation on the gain, right? Pretty much.
Yes. Yeah.
Okay, then we have to dismiss this thought. But anyone that doesn't have a concern about taxability on this, the strategy I told you about, buying the deep in the money call, that's like a no-brainer strategy for anyone that's owning the shares long term. And just so that you're aware, Asher, is that this is something where you can even take the long term and push it even further long term. So it's not like you're giving up your rights to own it. And you can take assignment if you want to, but you will never want to, because you're just in it for the gains long term. Okay. So
I think the
that's,
only implication of that, though, is I'll keep getting hit with tax, right? Like I'll get hit with tax now for realizing the 29K. And then in 3 years, if I'm rolling over to another 3 year, I'll have to take the tax hit then too, right?
yeah. And it's a long term hit, not a short term hit.
Yeah. Long-term gains. Got it.
Yeah.
Okay.
So
Okay. That makes sense.
And being a tax advocate as well, like as long as you're getting hit by the long term tax, it's definitely better to get hit sooner than later when the tax rates go higher.
Yeah, that makes sense.
Right.
That makes sense.
But if you're on the short term tax bracket, then I definitely favor that you should wait. If you're willing to hold off for a year into that position, then hold off for a year, kind of thing. Right?
So basically what you're saying is the better option here is a deep out of the money 3 year long, where I'll get the same
in the money.
In the money.
In the money. So it's going to just be like a stock, and I reduces my downward risk because it doesn't go down as much.
And let me tell you the other risk that you're reducing. And it's not a risk. You're reducing your capital significantly.
Because it won't cost me 80K to get that money.
Correct. You're going to only be spending about 60% of that for the same reward.
Yeah,
on the
that makes
top
sense.
Side. Right. So let's park that aside. This is just to kind of share that is an option, right? It's one possible option, but let's now hypothesize that is not an option for you. Okay, let's put that in a parking lot and put it aside, right?
Yeah.
So let's go to step number 2. Okay. Step number 2 is we have a put that you have bought, right? So that put that you have bought is, so that's like your insurance policy, right? Pretty much.
My goal was to make it 1-to-1. So if my NIO shares start to go down, my puts will go up. And so it should be, and I think I may have overexposed myself on the downside. So I'll make more if it goes down. So I was trying to figure out what was the right point to, and right now I feel, to be honest, if NIO, for example, this week goes up $10, I'm going to lose I could lose all my 60K here. So that's why I don't like having this big of an insurance on. My preference would to be a smaller put size, so that I'm not risking in case NIO does go up for NIO day.
So here's what I'm seeing, right? You have a V shape right now. Okay. So right now, the way I see your trade is like a V shape, right? And your entire V is green pretty much with this. So like what you have done is you like technically locked your profits on the shares by buying this put, right? It's like, okay, now if it goes down, this is going to pay you for every single downward move, offset on the other side. Um, I'm not a big fan of that because then you're not going to monetize anymore one way or the other, because you're going to lose on one side, you're going to make on the other side. So it's like you're like
Yeah, no, I,
this this
I yeah.
this is kind of like end game kind of thing. Like you're done. You're done with your Neo strategy. Now, here's what I don't like about your contract. Okay. I want to tell you that is, since you bought the put, right? Uh, it's a very expensive put, and you're going to be impacted by theta decay because it's only a few days out, where it's definitely less than 45 days out. And even if things move in that direction downwards, right? Your theta decay force will be more powerful than the delta
Mm-hmm.
change of the stock. So in a way, this is a really bad contract to buy, in my opinion, because being very short term. Now, the only time people buy these type of contracts is they're like extremely bearish on Neo. Like there's something very bearish going to happen, and you just want to be overly protected from your downside risk kind of thing. So that's the only time I'd recommend that, because you're going to lose your contract value pretty fast. Um,
Yeah.
the good thing is you've closed some of them, which is good. Here's what I would do differently, though, right? Instead of doing a buy put, I would actually sell calls against the puts, sorry, against the shares. Just make them covered calls, right? And monetize. Just make sure you take the strike out enough that you're protecting yourself, maybe 20% or 15% on the downside or something, whatever your comfort percentage is, right? So like I would, like an example, I would say, like you just pick a January contract, or February, whatever time frame it is, that you want to protect yourself, and just sell a call against your shares a little further out. Now, that isn't like, you probably now thinking maybe, oh, I'm capping my top side, right? So you already capped your top side on this strategy anyway by buying puts, right? Because you're going to lose significantly out of your puts. So definitely, compared relative to this buying put, the sell call is better. But now let's say we reach that level really fast, and then you come back and say, hey Mitt, like, oh, I really want to still ride this higher, right? Then we can roll that call out, or we can take the loss at that time, because you will have already benefited out of theta decay, because now you're selling. So now it is in your favor to do something shorter time and let it decay over time, the contract decay. So that decay is paying you money.
So Mitt, his actions, in my opinion, maybe yours too. He should just close this put position, right? Just,
Yeah.
just yeah, sell this put, collect that money, and then if do you want to share Tasty Works, Mitt, so we can kind of show him,
Yeah, I can
because I'm
demonstrate.
I'm
I'll
thinking,
share my screen.
yeah, because you can start like when he's saying sell, yeah, because a better way would be either sell a put or sell a call to kind of hedge, and yeah, like out of the money call, right? Like so $60 or 70, and you sell
Mhm.
that if Neo doesn't hit that by end of December or first week in Jan, you just collect that premium. Now, here's the thing. What could happen in NIO days? All of a sudden, let's go worst case scenario. NIO hits $70 the first week, right? So the call that you're selling will start to take a hit. But like Mitt said, when you're selling a call, you could just adjust it or roll it out, meaning you take a loss on wherever it is right there. You sell a further one out, $90 this time or $80. And because the price of NIO is skyrocketing, right? That you're going to get a lot of premium for that guy.
Yeah.
So then you offset the loss that you took on the January $60 call that you're selling.
Yeah, it's like a trade-in program. You're trading in one car for another car, right? So now you're getting better mileage, you're getting more value out of the new contract offsetted by the other contract. So
And would the premiums be cheaper? Because the premium on this, I'm paying $597 as an example for the December puts. But if I were to buy calls out of the money, I'm assuming those would be a lot.
you're not
No,
buying,
sell call,
you're
sell call.
selling.
Okay, yeah, selling. Yeah, so selling calls.
So what happens to the premium when you're selling calls? You collect it, that comes to you. You're not buying it.
Okay, so there's going to be basically premium going into my account. I'll just have
Correct.
cash.
Yeah.
And if
Correct.
NIO goes down, I get to keep the cash.
You get to keep
Yes.
it. Yeah.
And if it goes up, I've got to now pay.
You have to give up your shares at that price.
But you don't
point.
have. Yeah, but it doesn't have to happen.
It doesn't have to happen. That's
So
the worst
max
case
I can
scenario.
lose. The max I can lose is the money that I just got from selling that call, basically.
Correct. No. Hold on. Let's. I think we're kind of like. Let me get you up to the speed with what a covered call means. Okay. So you have shares, right? Okay. When you're selling, let's do an example. I think it makes sense to do it with an example, right? So let's say I pick a 70. Like let's use Leon's example, 70, right? So for every contract, okay, that I sell on a call, okay, for every contract I sell on a call, I'm going to collect between 118 and 116 and 118. So that's 117 average, right? So 117 times 20 contracts, right?
Yeah.
So the rule of the game is, okay, so let me tell you the first baseline rule. If you did nothing, no adjustments, nothing, right? The base rules. You're going to collect $117 per contract if NIO stayed below $70 by January 15th.
Yeah. Okay,
Okay.
that makes sense.
No brainer, no question asked. Now, if it
those will become
crosses,
worth zero, and so you'll just have collected that premium.
correct.
And you can just buy it back at $0 pretty much. So you've collected.
You don't
now.
even have to buy it back. It will expire worthless. So you
I
don't
see.
have to take any action after you sell this. If
Cool.
it stays below 70, that money will just end up in your account. No question asked, nothing, right?
Got it.
So
Go ahead.
but you're basically saying in that case, you just collect the premium and it's same way that contract expire worthless, same way you buying a call, and if price remain under that, same thing happen, right? In that case, you lose the premium and you don't do anything. So you don't have to.
Exactly. If you buy a call and you don't do anything, what happens? You lose your premium and it goes away, right? So now you're selling. So if you're selling, you're the one collecting from the buyer on the opposite side.
All right. Okay.
Right.
Got it.
So anyone, and I can tell you how many people have bought the 70 call, right? I can tell you. So are they fools? I don't know. They may be smart. They may be fools. We don't know. But let me tell you how many people open interest. Okay, we have about net 21,300 call contracts opened on 70.
That's a lot.
That's a lot of people, right? So you're selling to them pretty much. Okay.
Yeah.
So we're gonna buy we're gonna sell 117. So now you understand the downside scenario, right? Now let's look at the upside scenario, right? Let's say it reaches 70 really fast.
Yep.
Okay.
It's going to go up a lot, and I'm
It
going to have to owe back a
crosses
lot of premium.
70. It crosses 70. Okay.
Yeah.
If it crosses 70 by January 15th, and you take no action on it, okay, and I'm not saying that we're going to do this, okay, This is worst case scenario 1. There's so many worst case scenarios. Okay. So this is worst case scenario 1. Worst case scenario 1 is you will be giving your shares up at $70,
But you still keep the premium.
but you still keep the premium.
Yeah. Okay.
So 117 times. So the best way to put this logic in your mind is we're collecting 117, right? So add 117 to 70, right? So that is $71.17. Okay. So technically, the best way to think of it is you're selling your shares at 71.17. You're forced to sell it at that price.
So is that mean right now, let's say if it is 41, I would still collect that $29 plus the premium. Is that's what basically my gain would be? So my gain
Yeah. You would collect between the 41 price and all the way to 70. So whatever price you own the shares doesn't make a difference. Okay. You are forced to sell your shares at 71.17. Like today, you'll probably say, "Hey man, I'll take that money and run away at 71.17." But when it reaches that day, most people are greedy. They're like, you know what? This thing will go to 100 now, not 71.17.
Yeah.
I want to keep it longer, right? So here's the thing. That was worst case scenario 1 is you're giving up your shares at 71.17.
But
Okay.
still making money.
Still making money.
Yep.
Okay.
Okay.
You're making money on your shares and you are making money on the premium. Two income sources coming through, right?
Got it. Okay. That
Right.
makes sense.
Okay. Now let me go to what I feel comfortable doing. Now, this is like we're going into advanced phase a little bit, right? Let's say we're like January 10th and we see it's approaching 70 and it's about to cross 70, or maybe it has crossed 70. Okay. I'm just creating a scenario number 2 here for you.
Yep.
Okay. Or scenario number 3. I don't know what scenario we're in, but we're creating this new scenario that we're already here. And then you're like, hey, man, I don't want to sell my shares. I want to keep it. Okay.
Yeah.
I don't want to give up my shares at 71.17. I want to keep this, right? So at that time towards expiry, your contract value will have decayed. Okay. Because keep in mind, as time lapses, the contract value decays, right? As you're approaching that 71 number or 70 number, right? So at that given time, we're going to take a small loss on the 70, okay, and reestablish a new one further out at 90 at a future date, right? Because look, at January, I'm collecting 117. I can collect, like, look, at 70, I can collect 260 something, right? So at that given time, I'll be able to collect more than that even further out because the price has already moved higher. So the premiums expand with delta direction. Are
Yeah,
you
and also, this is like, let's say the price is $70 January 10th. Scroll up mid to where the price is.
Yeah.
$8, right?
Yeah.
So that you'll be collecting a lot of premium when you roll that out. So again, yeah, like you said, like that first week, it's getting close. It's 70. Like you don't want to sell your shares. You take a tiny loss on that. Basically, you buy back the calls that you were selling.
Yeah. Yeah.
So you take a loss on that.
So I want to basically get into call contracts, basically.
Yeah. So you want to keep your shares. So you close that January, you come to February, and you just double your premium or more.
Yeah, and you can see the logic working, right? At 42, it's trading at about $5-6, right? And at 42 in February, look, it's trading at around $8, right? So you're getting, time is paying you money, folks. Time is paying you money. Okay. The more time you push out, betting that it will go up to this price and not exceed a certain price, they'll pay you more money for that. So guess what happens? The more money you collect will definitely cover the loss of the previous position, but you will also make more premium in addition to the loss you're going to cover. Like just the way you're trading in a car, you trade in your old car, which has very high mileage, and then you get a new car with low mileage, but then you're getting the new car that is definitely paying for the old car, right? That doesn't happen in reality. But in this case, what's happening is you're able to get something new that's paying for the old and covering the old pretty much for you.
Yeah.
Okay. So this is one strategy you can implement in that, which is better than buying just the put, because buying the put, what you're doing is you're now introducing impact on decay of the contract because you're buying, you're not selling.
Yeah.
Okay.
Okay.
So this is one way of doing it. And the only time I end up buying puts is when I've got like a major storm coming or something. And I'm like, dude, like I might as well buy the insurance because this will save my portfolio X amount. And when I do that, I normally do it out of the money, not close to in the money or at the money, because at the money or in the money, there is a lot of extrinsic value that you're paying for the contract. You're paying more for the contract, less for the value, right?
Yeah.
Out of the money, you have less extrinsic value on the put.
Yeah, like I mean, though the reason I made this trade is because I am bullish on NIO Day. I think we may see a drop in the next week or two, and then
Yeah.
you'll see a dip, and people will buy it up, and volume will come back. And I was sort of trying to protect myself for just like the next week or two, and then just sell my puts and just
Okay.
be back in my position. That's kind of, but I think this is a little bit more long term.
Yeah. Yeah, this is long term. Okay, now
Yeah.
let me give you a little like insight, educational insight on buying a put, right? If you ever feel like there's a little bit of bearishness coming in, okay, even in the next week or two or something, try to
Yeah.
buy a put that is like at least minimum 45 days out.
Okay.
So why do I say that is because what you're going to see is within the last 45 days you're impacted with contract decay most. Like if there's a very small delta change or relative no delta change, you're going to lose a lot of value on your contract immediately, right? If you buy a 45-day out one, you will be more successful in your thought process because that won't decay as fast. You'll have more delta force, less
Yeah.
theta force. Now you would ask, oh man, it's really expensive to buy the 45, but just keep in mind, would you rather have your contract lose value in the short term, or would you rather buy something further out and then you have the right to close it as well before you even hit the 30-day mark or 40-day mark to lose a minimum loss, right? So you have to keep that in your back burner, that you can walk away with a small loss on a contract that is further out. That's why it's expensive, but it pretty much covers you. Fair enough? Like, is it making
Yeah.
sense?
Yeah, that makes sense. Yeah, I think this was more of like a trade I put in because I saw these puts go up like 40%
Yeah.
last week, just because like it's literally like buying calls on the way up in October. And so
Okay.
as an example, if NIO drops this week down to like $32, I'm just throwing it out there. These puts could go up another 40, 50%. And so, yeah, I'll make a huge loss on my shares, but my puts should go up 2x. So it's like very, very volatile, very risky stuff, but at least I might have double. I may have made 40% this week in these puts. So that's why I was buying short-term shares and for more of like a crash scenario for NIO as opposed to like a more bearish trend. Because I do think by Jan, I think it will pick back up. This is like if we see a flash crash in the next few days, like tomorrow or Tuesday, I can make a quick 30 or 40%, close that out, realize some profits, and then have that as my buffer space. That's kind of what I was thinking, but I think what you're recommending is more of like a longer term.
Yeah, you can see.
Scenario.
So here's the thing, like I'm more like I want to be in the lane in the game longer than most people. So you may be right. I'm not saying you're wrong, but if you turn out to be wrong, you have more to lose than the average like person that wants to stay in the game longer, right? So
Okay.
that's the whole idea that I'm trying to share, is that by doing that you'll be more successful trader long term, because you may hit, like, what are the odds that that's going to happen is what you have to ask your mind, right? If you're confident your odds are like more than 70-80% chance that this is going to happen, then that's fine. So right now what I'm hearing you say, you're also betting on implied volatility, which is volatility will expand on this on the put side, because it's just people are just going to be dumping this like crazy. So if that is a good like strategy in your mind that that's going to happen, then yeah, I'm all for what you're doing, but I personally wouldn't do it, because that's not like that. I don't see like huge huge consistent success in that model.
Yeah.
Like because I do a lot of trades, right? So I will never use that theory for myself, but it may work for you. Yeah.
Yeah, my fear is like I've gotten big winners, but if
Yeah.
I get a big loser, that can wipe out all my winners. So that's why
Yes.
I'm kind of trying to be safe a little bit, and it's now trying to preserve the capital than try to YOLO trade it all
And
away.
yeah, no, you're dead on, right? And I personally would say that just the way I think of this is um like
It
if you even did a sell call, like maybe at, let me see, it's like 41, right? Like if you did a sell call in the short term, like let's do December, right? 31st, right? You did it maybe at, let me look at the deltas here, see. Okay, like at 16 delta, so that's around, okay, you'll collect about $1 or something right there. So yeah, if you did this, man, like think about it. If you collected $1 for it not reaching 55 just by December, right?
Yeah.
That's like $2,000 right there. If you do your dollar cost averaging on the other side, that's like reducing your cost basis significantly. That's how much 20 contracts, that's $2,000, right? So that is how much protection are you getting on your contracts on the other side? You're getting almost I think about a 10% protection, close to a 10%, if I'm not mistaken.
Yeah, I was trying to get 1-to-1.
1 to 1, just protect
1-to-1.
Oh, yeah,
100%.
one-on-one protection. You're not gonna make any money.
So just keep in mind, 1 to 1 protection just means that you're canceling
Yeah, no,
the
no.
trades both sides. So
I totally get that. I totally get that. My thinking is I think we're gonna have a really rough volatile time for the next 2
Okay.
weeks, and I almost want to like lock in my profits now, but not from a tax perspective, take any tax hits, and come back in Jan 1st and unopen myself, like, and get back into the market. So it's like,
So you are going to take a tiny a small one, right? Because you're going to have to close this put before. Yeah, you're going to have to close this put. So that's going to be
yeah,
a
well, I
short-term
mean,
gain. Yeah.
I hate holding this put like over the weekend. It scares the like shit out of me. So I probably will sell tomorrow. But if you guys can I share my screen one more time? I want to show you
Yeah.
guys something, and I'll tell you
Yeah.
maybe why I'm buying a put,
Yeah, sure.
and maybe you guys can.
Yeah, and then maybe we can switch to Shani's scenario and see if this also applies.
So can you guys see my chart here?
Yeah.
Yeah, yes.
So this is what's scaring me about NIO is like this is the daily, and you've seen the rise. Like we've kind of this is when JP Morgan pretty much made their $40 price target, and you can see in 2-3 days we had the spike up, and so I was buying calls here, and you can see we're always basically, this is your 21-day EMA. What scares me is I see a classic head and shoulders on the daily, and I see this sort of death doji. I've been trying to over the weekend figure out what that means, but to me that looks like a very bearish candle. And so I see still we're not crossing the MACD yet. I think, and this is why I bought puts, I think we could see a test here, potentially breakthrough, and maybe even a test down to $30 here. followed by like just like another just bear market like this, kind of like Bitcoin did in 2017. So that's the bearish scenario. And because I think this head and shoulders and this red sort of volume didn't come in here I don't think you're going to see that volume come in just because there's so much downward pressure on the MACD here. So when I kind of just zoom out and I see like this, I just see downwards pressure. So unless you guys are seeing something, and I get the fundamentals is I know you've got basically NIO day right here, but I just think in this time frame, this looks like a very clear, I think, downside to this 100-day moving day, which is $30. So that's why.
Okay, so yeah, I've got a couple comments on this. So first, you're right with the overstretch of the technicals, right? So after, if you go back to the 26th of October, that's when this recent run up started, right?
Yeah.
And that's where we got overstretched because this was the biggest run in NIO. Now on the head and shoulders, that is not a correct head and shoulders because it doesn't fit the pattern. Now there is this thing called a rough head and shoulders. But rough head and shoulders are less likely to play out than a true head and shoulders because you see those candles. I mean, they're closing below that neckline. Like that neckline needs
Talking
to
about
contain
these ones
the
over here in intraday.
Yeah. All those several candles are breaking this pattern already, right? So that's not a true head and shoulders. However, this is a top of a it's called like public distribution. So there's a market cycle, right? So if you look at so those first candlesticks you see at the bottom, right?
Yeah.
That's called accumulation.
Yeah.
Then the run up is called public participation. And then the top is called distribution, right? So basically the people that bought an accumulation are selling in the distribution. So that is intact. That's correct. That's a market cycle.
Yeah.
But yeah, the I don't think the head and shoulders is correct per se. Now, I personally, I do not think we're going to hit $30, but like again,
I think I agree with the head and shoulders, but what I'm seeing here is that this sort of parabolic run is starting to cool off, and we tested the 21-day, we broke it, it became resistance, and now we're on our way to test the 50-day EMA, and that's going to become our support, and we may break that. And then you got your 100-day. So obviously I'm painting a very bearish picture, but I'm seeing declining volume, increasing selling pressure. I'm not seeing a reversal on the MACD. So when I look at it from a technical perspective, the only thing I see that can make this thing bullish is just NIO day, and that's not happening till over here. And so that
that's a good fair analysis. One thing I would add though is so the news came out on Thursday that NIO and Tesla were doing the offerings, right? It's basically diluting shares and whatnot. And we had all day Friday to crash, but the price didn't. I mean, it went down a couple bucks. So that's kind of one thing to pick in mind. And then on the MACD, I do see a flattening of the histogram, right? See how it's not like. I mean, it's a flattening. It's not like the first four candlesticks.
Yeah, I guess you're saying
it's acceleration, right?
Here, right? Yeah.
Yeah. So again, like we do need more information. We need to see what happens.
That looks scary, and I don't see this thing kind of turning yet.
Yeah.
That's what's scared. I agree with this, but what happens if you get like another candle that starts now another deceleration?
Yeah. So if that happens, your put's going to make a lot of money on Monday.
This is the only thing that's kind of making it bullish, is that we're kind of selling pressure starting to go down. So we're kind of pretty.
Yeah, and also it's oversold in the stochastic right there.
Yeah, it's super oversold. That's why
it's super oversold. I would watch this position very closely Monday morning.
I've got all my alerts here, so
I mean, like literally, you need to have this thing open at 8:30 in the morning, right? Or I don't know what time zone you're in, but
yeah,
because you could make a lot of money on that day. But then as soon as that happens, like I would take off. I don't know if you want. It depends on your risk profile, by 25%, 50%.
Yeah. I just see this move happening. Which will create a trigger to make this move happening, which will then create consolidation in this period. and and my worry is Q3. And I remember I was on the Zoom call with you, Leon. That was the first time on the Q3 earnings call where NIO got dumped on the earnings call. If you remember, there was a dump and then there was a buyback after. My worry is you see kind of like December 2017, you see this you see a rally to NIO Day, and then you just see this dump like no other, because we don't hit the 50. And so then you just create kind of like this long-term bearish looking trend on NIO.
It could happen. Yeah, that could happen too. Yep.
You see, if that's the case, Ashar, why would you even hold your shares then?
Well, I mean, I can tell you, I can tell you long term, and Leon probably knows from the Discord, I'm like one of the most bullish long term people on NIO. Like I was buying $25 calls back in like months ago, but
yeah, okay.
No,
This is
I'm a technical and fundamentals trader, so I see that. I agree that there's still social arb in this long term, but this to me just looks technically like a really bad trade. Versus if I were to look at a Bitcoin, it's a lot more healthier of a, like here, you're not seeing a test back here. You're kind of seeing now a run up. We're probably going to cross 20K this week. You're seeing higher highs. You're seeing higher lows. But when you see the NIO chart, it's not as, here you're kind of seeing more downward pressure. That's why.
That's good awareness, by the way. Yeah, really good.
Yeah.
So ask yourself another thing, Ashar, is because here's the thing. I've like moved away from charts because I can devise strategies where I don't have to look at charts anymore. And I try to devise it that way. So I'm making consistent returns rather than doing the quick big wins or big losses kind of thing. Now that retailers are controlling the market, do you feel things will pan out this way? Like because just keep in mind, it's no longer about fundamentals of NIO. It's also about like where most retailers are parking their money, right?
Yeah, money flow.
I posted
money
this
flow.
in the
It's more money
Discord.
flow.
I don't know. If my hot take is I think that Tesla being added to the S&P is going to pop the bubble and we're going to see a crash. I'm being super bearish, but I'm trying to preserve the capital that I've made. Like I've made capital that I never had 4 or 5 months ago. And I think a lot of people in dumb money are in the same situation. And I was in the 2017 crash of Bitcoin, and I saw the exuberant CNBC in December 2017, everyone talking about Bitcoin, and Jan and Feb and March, and it just was a disaster. And so I see a potential, a scenario where 5 years in 2025, we're going to look back at the 2020 EV bubble where Tesla got added to the S&P inclusion and did a 10x in a year. And the retail traders were right, but it created a huge crash. I think and I think you keep seeing it with like the fear and greed index. I'm just painting, even if you look, for example, at the Tesla chart, you're seeing the same thing. You're starting to see this parabolic rise is starting to kind of, like even for Tesla a little bit, we didn't make a higher, like we're kind of starting to potentially fall down here.
Yeah, so I've sold a call at 800 on that one, expiring next week.
Okay, that's nice.
Yeah, so 800, not crossing that. No.
Like you could see kind of you need to see basically a higher high here, or it's going to drop back. Like this is all short-term stuff, but I'm just thinking like because of NIO, the signs that NIO is giving me that we could see some downside. And the thing I'm noticing too is if you go back before if you go back NIO, this is before people really knew about it, but when NIO broke the EMAs here, it not only broke the 50 EMA, but it also broke the 100 EMA, and it went pretty far down from that EMA. And so my worry is this is the type of NIO type day dump you see, because that's typically when you see, even here as another example, when you have these.
I'll tell you why that happened, because that was like quite a bit of institutions involved in selling it. So They switched hands with the retailers. That
Yeah.
I
I
could.
mean, I'm throwing like, obviously I'm throwing super bearish scenarios out here, but like, I mean, what if you see, for example, something kind of like that going on, right? And that puts you at $19 on NIO. So that means I'm basically all my open P&L, I lose it. And so I don't want to do that. I don't want to just watch all my money go to zero like I saw in December 2017 Bitcoin and people capitulated. And so I'm trying to at this point where I see where I've got P&L and people have made money, how do we start locking it in? That's why I was trying to buy puts short term.
Yep.
Yeah, so watch that put closely. Definitely close it next week, like the first half of next week, and then consider selling covered calls on your new position. If you want to, it sounds like you want to keep holding those shares. So you can just hold those shares, and every time you collect premium, you're basically bringing down the average cost of those shares. So it's you know what I'm saying. So you do the calculation and whatnot. So yeah, that's good.
I'm interested, Leon, because you've got NIO too. What's your plans over the next? Are you just going to hold tight?
I have a very different strategy from it. I'm willing to lose 50% of my money. So if you're on the buy side, so if you're on the sell side, I mean, there's no stress.
There's no
You
stress
can relax. You can go to sauna, have a drink. Like you don't like on the buy side, it's going to be really stressful. So you need the appetite to be willing to lose thousands or tens of thousands of dollars. But you have to have conviction in direction, right? So I'm willing to lose 50%. I'm down 20% at the moment. And I'm holding. I'm not selling any puts or calls or anything.
So I would say maybe I'm fortunate here, but here's what I did. Okay, let me share my story in NIO from the beginning to the end. It was simple, right? I bought into the January calls with Leon at I think it was 25 back in the day when we first started. It made a run all the way to 50. Okay, I closed that out, but before I closed that out, I set up a sell call at 43. Okay, it was a little in the money, but the reason I did that because I was collecting about $900 out of that. Now, when I'm collecting $900 out of that, my break even here is like almost $51, $52 on this contract. I will start losing money in May 21st after it goes up to $51, right? If it stays below 43, I will make the full $900 on just one contract, not 10 contracts, just one contract. What I did is I replaced the long call that I had expiring January. I replaced that one with a 42 call expiring in 2022. So I can still remain long-term bullish. But now here's the beautiful thing, right? I collected about 2,500, 2,600 bucks on that one contract that ran out all the way to $50. Okay. Actually, it was more than that. I have to go look at the price, but let's assume 2,000 something. I sold this one and I purchased this one for 1765. So I'm not only harvested, now I'm back in at no cost. Like I'm sitting and coasting here. I don't care what happens to NIO at this point because I've taken my profit, part of my profit. And now I'm just back in on a long-term contract, selling calls against it. And I'll collect a fixed return on this one, which makes it a no-brainer trade. So I'm just going to chill and relax on this one. I don't have it. That's why what I do is end up like once I know that it's a chill and relax trade, I tag it as a long-term monitoring trade. So I don't do any charting, nothing. It's just chill and relax.
I think for me, I'm like kind of like with Leon, where I just
Yeah.
make I just want to make tons of money on the way up and tons of money on the way down.
There are two kinds of personalities I've found. Okay. There's literally two kinds of personalities. Okay. One personality that does the Leon style and then makes a significant amount and then comes into my boat. Okay. And then there's the other personality where they're in my boat from the beginning and they make quite a bit of fortune over time with compounding growth and then eventually use their profits to get into Leon's boat.
Yeah.
So
Yeah.
like I've seen both those personalities kind of thing. I'm more like 50-50. I personally don't like care about one side or the other, but that's how we trade kind of thing. Is we make sure we make a consistent return on multiple trades with a high batting average, which means most of our trades should be a winner, not a loser. So 98% of our trades are winners, 2% are losers, and the 2% of losers, we come and fix them up. So, and we may not make 200%, but we'll walk away with a nice 40% return.
Yeah, I definitely think like NIO was
Yeah.
sort of like that one or two trade of a year type of scenario. So I'm definitely don't think that I'm
Yeah.
gonna see that again. Like I'm not gonna expect that again, that I can just go buy calls and it's gonna go up 500% in like a month.
This market, I don't think it's done. Like a lot of people are calling for. This is just my opinion, but I think there's a lot of. I mean, there have been these opportunities all year long, right? This because of COVID, the stimulus,
Yeah.
and I think we still have time. There's still stuff coming. So that's good. I think he's got action items of what to do. I think we should switch to Finette. And I can pull up his screen, the screenshot I took.
Yeah. So, Vineet, like, were you following along with this conversation? Was there something that
Yeah.
threw you off, or did you have some questions around that?
No, it's kind of making sense, but again, like the question that I have is more on the basic side, right? So I'm still trying to make sense. I'm capturing that, like you said, where it makes more sense, that where you can, you can bound your profit into certain limit by reducing risk of, where you selling a contract, right? Do a sell a call versus a put a call, right? Because if I buy a put, I'm paying a premium to reduce my risk, versus I can sell a call to get a premium and reduce my risk, right? So it's kind of making sense, and that's what I'm trying to see, how it can apply to my position, where I have, I'm not very big in position, but like whatever is there, I'm trying to reduce risk on that. And
Okay, what is your position again? Just tell me the contract you have right now.
So I have one contract that is
45 something.
strike price is 40,
40.
and I think expiry is on February 19th.
Yeah.
But I bought it at $19.
I can share my screen, Matt, if you want.
Yeah, I actually can. Here, I have it open already. I was looking at it. I probably failed.
Yeah.
So you're talking about
essentially-
this one right here, right? The February 19th 40 call
That
you
one,
had bought,
that one.
right? So right now it's trading around $8.90, but you bought it at 19, you said. Is that what it is?
Right.
1965.
1965. And did you
So
buy it
down
like when
50%.
it was like 50 or like high 40s or something?
Yeah, it was close to that, because earlier I was into NIO. I bought, like, I think I got it like about 23, then sell it. Like, so I was selling and buying during the time. So I still hold like about 290 stock on NIO. But
No. Like I'm ignoring what you own on the stock
Okay.
side. Like that's a separate trade, right?
Okay.
On this one, when did you get into the 40? What was the price at that
Yeah,
time?
I think it was about high 40s or close to 50.
High 40s, 50s, right?
Yeah.
Okay.
So it
So
was like-
so most of the risk that you have, like I'm just trying to calculate in my head, most of the risk that you have is delta risk, pretty much, right? Because delta means the stock price movement has caused your call contract, not
Right.
data decay or anything. And
Mostly, yeah.
and you made money on maybe some volatility. So delta hurt you a lot, and maybe IV helped you a little bit, like
Right.
implied volatility helped you a little bit. So yeah, you're probably down 50. So now what's your thought process? You want to stay bullish or bearish, or what's the thing in your game? What's your game?
I'm still bullish, but I want to reduce my risk, because like I say, it's already 50% down, right? So what I can do to minimize that risk, right? Even so right now my break even is 60, approximately
Yeah.
60. So if I sell a call, if that's a something strategy that I can go like $70 sell a call and kind of get some premium and reduce my risk there? Or, you know,
So
again,
so here's couple of things you can do, right?
Mhm.
These are no-brainer trades you can do, right? Like in February itself, okay? You can convert your strategy to a vertical strategy,
Okay.
okay? And what I mean by vertical is like a spread pretty much. So if you sold a call out here somewhere, right? Right? If you sold like maybe 60 or 50 or whatever your like end limit is, right?
Mhm.
You'll collect an additional five something bucks or something, right? So from this point on, right now you're already at $9, so you've lost whatever you've lost, right?
Mhm.
But then what you will do is you collect some of these premiums here, whatever your choice is. You can pick a 50, you can pick a 60, a 70. But just keep in mind, the more out you're going, you're collecting less, right? You're
Right.
collecting here about 570, you're collecting about 270 here, right? $2 here. So that is helping your offset. It's helping offset any further declines you're going to get, any
Right.
further, right?
Right.
Right. Not what you have declined so far. Anything you lose now prospectively, yeah, this spread will help you now pretty much. And
Mhm.
guess what? Your cost of this trade is just going to be simple. Like let's say if we did 50, right? I'm just making this up. If you sold a 50, so you just take 50
Right.
minus 40, that's 10. 10
10.
times 100. This is $1,000 trade. Okay.
Right.
And then you're collecting this much, right? So that you're going to subtract that 500 out of it. So your
Yeah.
net is about $500 trade, right? So
Right.
you have to keep that in mind. So you can convert it to a spread to alleviate that. Um, and then
Well, yeah.
obviously you can go in closer, okay? Like you can go in closer to December and sell calls. Like, so here's how I like to play it, right? I like to keep selling calls like at least one standard deviation out uh, until it doesn't achieve. I'm lowering my cost basis on the other side, right? So you have bought this one, right? Uh, what is it? January 15th, 40. What is it? February. Sorry.
February 19th, I think. Yeah.
Yeah, this one right here. So like let's say it's like trading at about 890, right? So I would go in like December 24th and I would go like at least see if I can collect decent amount. Okay. Yeah, I would go one standard deviation right here. There's a dotted line right here. I sell a $1 right here. Okay. If it doesn't go above 50, fine. You collect the $1. And then go to next week, collect another dollar. Collect another dollar. So you're keeping on lowering your cost down, right? From 895 to 795. Like you're pretty much paying yourself.
So you're saying basically start with 24 instance for 24 December, and if the price stay under it, I'll basically keep the premium, and then again do sell another call,
Yep.
and then another in a week or two, and then basically go a
Yep.
little bit up, but you keep paying toward your cost of that initial
Yeah.
call
So
level.
this is only because you want to remain bullish, right?
Right. Yes.
Yeah.
Yeah.
But after listening to Ashar, right,
Mm.
maybe you may not feel that way, right? Because he did a nice little presentation with the technical chart that made us feel like it could go bearish, right? So it's a matter of opinion, okay? So
Right.
right, it's like if you're that bearish in the short term, I don't think you should even keep it open, okay? Like if Ashar is right,
Mm-hmm.
then this strategy is not going to pay you a lot, okay?
I
It's
see.
just going to lower your cost basis little by little, like inch by inch, little inches, right?
Right.
So it's
But you
not
can
like you're
recoup your
going
whole
to,
loss this
yeah.
way.
Say it again. Sorry, I missed that last part, Leon. What you're saying?
You recoup your entire loss this way. It's just going
Yeah.
to take a little bit, right? It's going to
Yeah.
take like a few months, but yeah.
Yeah.
Okay.
And it's inch by inch, which means that it's not like you're going to mint quite a bit. And here's another part to it. Like, let's say it ran up to 50. Okay. I'm just making this up. If it ran up to 50, right? I'll be fine with that because if it goes up to 50, the call contract that you have open will make you money,
Right. Okay. Yep.
right? But if it crossed 50, that's where now your cancellation is happening, right? One contract is canceling the other contract.
Right. Yeah.
It's like the cancellation force is happening. After 50 is when the cancellation force happens.
Yeah. Yeah. That makes sense.
Yeah. So the only time I would say like you do a spread is if you don't want to manage week after week after week. You just do the spread and then forget about it. Just hold on and hope for the best, right? If you do the spread, pretty much you don't have to manage it every day, right? Like, let me give you an example.
Yeah, and I think in his situation, we should do the spread.
So,
yeah.
and again, we're not talking about covered call or anything, right? There, we just basically sell the call at 50.
The same expiry date. So you're not going to make money. You're not going to make money after 50 if you sell the 50. You're not going to make money after 60 if it goes above 60. You're kind of capping it at those levels.
Right.
Right. That's all you're doing. But by capping it, those levels, they're paying you money to cap it. Someone's paying you money to cap it, pretty much.
Right. Right. No, that makes sense. I think I'll follow what you're saying there. I'm just trying to see that, either go long into like 20, in February, or, another approach, like you said earlier, go step by step into like a week or two and then sell those calls and, recover it toward the cost.
Yep. That's pretty fair.
Okay.
Yep. So now I'm totally on board with what you're saying. I'm just a big fan of the vertical if you're you want less maintenance. And I'm more a fan of doing the weekly ones, like collect dollar every week. If you have time to log in like every week and just kind of check in kind of thing, right? So it depends on your trading habits, like how frequent you can be involved in the trade and how less frequent you can be.
Yeah, I'm definitely looking for where I have less maintenance, but where I can also reduce the cost and make some profit too, right? So let's look into, so you see, the numbers right now here is because my I paid so the strike price was 40, right? And I paid the premium of 20. So in that case, the break even is, if I look at that, my break even is 60, right? So if I sell a call with a 50 on the same strike or same expiry date, I'm trying to understand where I'm basically locking myself into with the profit perspective. Is it
good question, right? So now here's the thing, like the way you can think about this, let's logically calculate it, right? Okay. Logically calculating it, you started at about 19, it's down to 9, right? So you lost 10 already, right?
right?
Let's put that, you're parking 10 loss, which means 1,000 loss. Just let's park it parking lot 1,000 loss right there.
Right.
Here, by doing a 50, you are recouping about 570 out of the 1,000 that you have lost, right? Okay, you are recouping this. Okay, but okay, keep in mind, by selling that, you're recouping this, but you're not protecting yourself from further downside, right? So that means if it goes further down, like if it goes further down to 7 or something, like this contract can go down to potentially 8 to 7 to 755, right? So if it goes further down, what you're doing is, this is just protecting you by about $5-6, right? Out of this trade.
Right.
So all you're doing is now prospectively, any loss you incur further down, it is covering you.
Protected, yeah.
It's protected by $5-6 further down, right? From the $8-9 that you have.
Right.
Remaining.
That
but if
makes
it
sense.
goes up, if it goes up, significantly up, right?
Right.
All the way to 50, then guess what? You're still going to collect this money, Okay.
Right.
And you make the ride on this one back to whatever level it goes all the way to 50.
Right.
Right. So that's all this is doing, is like it's letting you stay in the game longer. Is all it's doing is letting you stay in the game longer because you're still bullish.
Right. So ultimately, if I go with this one, what I understand, it will recover my, let's say, my out of 1,000, it's recover my 500, right?
Yeah.
And then if it hit above, I'll still collect this 10. So,
Yes.
but as long as goes keep going up, I would not do anything. But I restricted myself into reducing my risk for sure by $500 that I already lost, right? And then it will not make more than 50 because if price keep going up, I will not make anything on that.
Correct.
Right.
And let's hope that the price runs up really fast up, right? You want it to run up fast in the short term if it does, right? Like if it goes back to like 47, 48, this one will be losing money, okay? And I'm okay with that, but at least this is paying for the loss on this one, right?
Mm-hmm.
Yeah. And time is decaying. So that means the theta, you're making money on the theta on this one right here while you're making, well, you see theta will be declining on this one, but let's hope that that move up will move this delta closer to a lower theta impact, right? So
I see.
delta will have more force than theta as the contract goes more deeper in the money.
So what you recommend in that case? Let's say we're expecting if there's a shift in the price upward to happen, fairly quickly, right? So as reaching to 750 is something we can do with that. So because I sold that call, I can buy it so that it can keep going up. So I can get it going further up and not lose, but I can make on it because of my buy.
You can go ahead and close this out and push it even further out if you want to make more money on it, right? You can push it out, but you'll have to push it out at a future time, so
Right.
you make more money. At this time, the same time frame, you won't make more money because there's not much premium left. But here's where I'm going to tell you frankly that the game that we're playing now is like a salvaging game, right? And this is where I'm like, I kind of get antsy on, and antsy in the sense that I don't feel like comfortable with the fact that, okay, now you're like very directional on this. Now you're kind of like sitting on the fence. Okay, should it go up? Should it go down? Asher just shared with us a very bearish case, and then we did like speculate a bullish case, right? Like, yeah, I'm out of this type of game already. I don't play these games anymore. Like, I know this is not like for me logically, these type of games don't work long term. So I'm out of this type of strategies. Anyway, like I shared what I did in NIO. Like I make my money harvest, I sell premium immediately. A lot of people call me fools at that time, right? They call me fools at that time. They admit, why are you capping your profit here? Yeah, this thing can run all the way further up. I said, I don't listen to that. I just sell it. I make my money premium selling. That's it. I made my rules ground and clear. So I'm going to cap my profit at X percentage and I'm done. So yeah, what I'm trying to do is help you out if you're staying bullish still. If you're
Right.
going bearish, then this is not a good strategy for going bearish. If you're going bearish, you might as well just close your call at whatever price it is right now.
I see what you're saying. Okay. So it makes sense that let's say if I'm staying bullish, the best I'm looking at it, go with February 19th and sell a call like approximately like 50. The
Yeah.
strike price.
Yeah.
Or-
If you're going to go, if you want to remain bullish, yes. Yeah.
Makes sense. Yeah. Okay.
Like you're expecting not to lose any more than what the price point is right now. Kind
Right.
of thing. It won't go below $40
Right.
is the bet you're trying to place.
Right.
Quick question. So how
Yeah.
long have you been holding this position?
I need to look at what date it was, but like
Like, is it over a month? Like 30 days?
I believe so. Or
Okay. here's my strategy. So I would not sell this until it's at least 30 days. If you were going to sell it, right? Because here's the reason why. So what to claim a loss on your taxes, you have to be in a position, and correct me if I'm wrong, Mitt, like 30 days. You have to hold a position for at least 30 days to claim a loss, which will offset, any of your gains, right? So
Yeah, are you talking about the wash sell rule?
I guess so. I forget the name of what it is.
Yeah,
It's
it's
just
called wash.
claiming a loss basically on a trade. That you need to be in it for 30 days, correct?
No, you can claim a loss, but if it's a wash sell, then you cannot claim it if you're doing the same trade that is counter reacting within I think is within 60 days of that time frame of that trade. So that's the only reason. But you can claim a loss. It's called a short-term loss. If you bought it today, sold it tomorrow, your
Yeah.
loss, you realize the loss pretty much instantly.
Oh, okay. So that's a 1 day thing. There's no time limit.
There's no time
Okay,
limit
yeah.
unless you're doing like a same trade again to monetize, then they don't let you take the previous loss. Like let's say you
Gotcha. Yeah. You have
this is the
multiple
IRS
NIO calls.
crazy rules, right? The IRS rules, like if you bought the same call again and then you made money off of it while you lost on this one, that
Oh,
that
so the question:
gains
what if it's
cannot be
$5?
canceled out by the loss.
Exactly on the same contract. Well, what if it's $5 up or down?
It doesn't matter. That's a separate contract. So that's
Okay.
a
Well,
difference.
that's really good
Yeah.
to know, people. I just want
And
to bring that.
let me reiterate, that's the best of my knowledge. I'm not a tax advisor here in this setting, just no financial, no tax advice, kind of thing. You all need to do your own research, but that's how I have experienced it in my account.
Yeah, and I just want to bring up the tax implications here too, because that helps offset the taxes you have to pay on your gains. So
And just to confirm, like you said, that it would be wash sale if I get into the same trade. Means, so it does not matter. Like this is a buy call, and I'm closing that in a loss, for instance, right? And if I make another trade, basically, I think that offset of that loss basically kind of add up to your next price, and I think that's what wash sales does it. But is it mean to be just you saying it as long as it's NIO and I'm doing a buy call, then only
No. You're buying a different contract. You're buying a different contract, so it's a different rule. It's a different product, right? Each contract and strike price is a single product. Like every product is separate. Yeah,
Right.
don't look at it like in the stock world. NIO is NIO, right?
Right.
You can buy NIO, sell NIO, buy sell NIO, right? You can create a wash sell situation easily in the stock world. In the option world, it's like if you ended up buying the same contract, like February 19, 2021, 40 call, then you're creating the wash sell type of scenario kind of thing.
I see. Makes sense.
Yeah.
That's good to know, because I think in case of stock, it buy sell does not, it apply there. But like you said, in this case, there's two different completed product based on maybe strike does not matter, but you said the expiry date would cause it to consider the same product.
Yeah, combination of strike expiry date of every contract has a code. If you notice, we call it, the fancy word is called, I think it's kind of like QTP or something. There's a code for it. Each code is a separate product. It's a traded product, right? So then that's how it's been distinguished in the record keeping process. But if you end up trading the same code, which is the same expiry, ticker, and strike, that's equal to one code. Yeah.
Okay. Makes sense. That's good to know, actually. Thank you.
Fair enough. Yeah. So that's pretty much it. Are we good with NIO for now?
Can I ask you one more thing?
Yeah. Go ahead.
So,
Anytime.
like, I have some of those stock with NIO too, right? I bought, so my average is like 45. It's trading 41. Is there something that can be done to, I'm bullish on that, but I want to protect it. I don't know.
So for every 100 shares, we can go back and do the
covered call,
like the one that I described earlier with when Ashar was on, right? When he started doing that same, you can formulate something in that. for every 100 shares you have.
Right, makes sense.
And if you want to formulate something like you're picking a strike or something, and you just say, like, hey man, I'm gonna buy this, I'll give you like a thumbs up, thumbs down based on what I see on the strike prices and all that. But I think the first choice decision should be, what are your levels, right? What is your comfortable level? Like, are you gonna like bet that it won't go above 50, about 60, right? You find that level, and then we have the conversation again, and then you're like, okay, thumbs up. Like, but if I find a contract that is better, plus or minus $5, I'll tell you, hey, look, do this instead versus this one, because it gives you a better premium amount, kind of thing, or has more volatility in it or something.
So help me here, if I'm thinking right. So if I want to reduce my risk, let's say for instance, and it's kind of, I see a short-term volatility there. And, like I said, my average is 45, it's trading 41, it's expected to go down. So I'm looking, rather than, selling a call long, deep into
short term, buddy, short term.
out
Let's keep
of
it
a week
simple.
or two, and then collect a premium on that while it's volatile, right? So it basically offset any kind of loss I do. As the price going
But
under 41, I
you don't
collect
have to
premium.
worry about volatility at all,
Okay.
right? When you have shares, you're just covered call. Very simple. Let's not try to beat the horse like crazy on that one.
Okay.
Like pick a date by which you want to set the target date, right? Let's say end of the year, right?
Mm-hmm.
Pick end of the year, right? And then let's say it's trading at 41, and you say, hey, look, yeah, I don't think it can reach 50 by end of the year. Okay.
Mm-hmm.
You just make that up along the way, right? And by the way, I have tools right here in Tastyworks. That's why I'm not trying to promote Tastyworks here, but look, like, you see this little brown bar right here?
Right.
Brown bar? This is the expected move, okay? Like, I can see the expected move all the way, like, it could go all the way to 49, but 50 is outside the expected move.
I see. Yeah.
Okay, so like, this is not like telling you that it won't go to 50. It just says, based on the bets and the volatility calculation and all the calculations out there, that there's less chances of it going to 50.
Makes sense.
It
Yeah.
could change based on all the money flow coming in and going out, right?
Right.
But as of today, at this time, this is what it is, right? So then I feel comfortable at 50. I'm going to just sell a call at 50 here. Guess what's going to happen? I'm going to collect $171 per contract. If I have 200 shares, every 100 lot shares, I'm going to collect 200 and wait, this is $340, $342 to be precise. I'm going to collect $342 on this for it not going up to 50, and I won't have to do anything with my shares. I just hold on to my shares.
Right.
If it
So
goes above 50 is when I start losing a dollar on this. Yeah.
So because, see, the reason I'm thinking more short term, because I'm bullish, I don't want to give it enough time, because I'm expecting it will go up, right?
By when?
But in a
By
week,
when? In a week? Okay, so
in
you want to be bearish for a week and then bullish after that?
so I want to be, yeah. So let's say I know that in a week, price may fluctuate because of all the new offerings and going on, right? So I say, let me stay in a week expiry, right? And then sell that call. I know that it will not hit that 50. Versus hitting 50 in a 4 weeks is a good chances there. So,
Okay, let's go step by step, right? Okay, so you're saying in a week, in 11 days, chances of hitting 50 is very slim, right? Okay, so I'll collect $1 instead of $1.70, right? I'll collect $1, $2 whatever. So times 200. If I have 200 contracts, I'll collect $202. And then this will expire worthless after December 24th, which is in 11 days. And then you're back into your bullish game because you still own your stocks.
sorry, I lost you there. I was disconnected, but
Yeah.
You were saying to, if you can repeat, maybe you're saying to go
Okay. If you're telling me just for the next week or so,
Mhm.
you are bearish, and then the week
Right.
later you're bullish.
Right.
Okay. let's hypothetically say that, right? Because that's what I heard you say. Then you can sell a call expiring December 24th and collect premium on it.
Right.
And then at 50, and then the week after, if you're expecting it to go up, this has expired. You made your $200 and said
Right.
goodbye to it.
Right.
And now you're back with your stock position, which is going to remain bullish.
Right. Because truly what basically happening that in that case, I'm trying to protect my stock that I have it, right? Because, and I'm kind of more into probability where it will, like collect a premium. And if it goes down, I still have something in my hand, right? I don't want to sell it
Yeah,
off.
$200, man.
Yeah.
$200 for like, if you had two contracts, you're going to make $200. This just for it to go down.
Right.
Right.
Okay. So how you would deal it? Let's say, for instance, I have a contract, and if the price goes up, but I don't want to give it up. How do you execute it so that I don't want to give up my shares? You
close the contract before it expires.
Okay, and then you pay for it, I guess, or
Yeah, whatever the loss is, realize that small loss, and then let the stocks ride.
so truly, like when I sold it, I collected a premium. When I'm closing it,
You're buying it back. Yes.
buying it back at whatever and then what are the differences? That's what basically you lost.
You lost, or you probably make, or whatever.
They're
Right?
making
Because,
maybe very low.
yeah, maybe like it didn't go all the way to 50, like it's about to reach 50, but then you do it like the day of expiry on the morning, you may be collecting like 50 cents out of the dollar or something like that. You can
Right.
walk away with 50 out of the $100, right?
Yeah. So it basically give me some protection by collecting a premium. But if it goes in the direction you expected, then just you minimize your profit there, but you still goes in that direction and keep it up.
Yeah.
Okay, that makes more sense. Yeah.
Yeah, we're premier sellers, buddy. Premium sellers.
That's making more sense. That's making more sense because like this is fairly new to me. Like I said, I'm trying to make sense of when you talk about doing a spread and how you kind of finance your own contract basically, right? So that's kind of pretty interesting strategy there. By make money by selling contracts and then again stay in the game. Yeah.
The more you stay in the game with us, the more you're going to learn interesting premium selling strategies that are no brainer.
Mm-hmm.
Where you're going to be like, wait, I wish I could just do this and make my return rather than having to worry about all this charts and all that stuff, right?
Okay.
So but it's everyone has their game style, right? So in our community we have like 3 groups.
Mm-hmm.
We have like the jellyfish group, which is buying calls and puts and optimizing that. We have the premium sellers group, where we're collecting income weekly and 2 weeks and everything. And we have into the future group, where we are like doing strategies 1 year out.
Okay.
And putting them on and forgetting about that, right? So you have your own trading methodology. You want to earn income here. You want to just make your supernova returns here. If you want to like do long-term strategies, go here. And we like to talk about long-term some strategies during our Saturday sessions, and you will hear us talk about like Tesla or Dropbox or different strategies in the future where you're protecting your downside significantly and you're riding it up pretty much. So it becomes like a no-brainer strategy. And then you like, everyone, actually the funny thing is everyone walks away with that call like scratching their head. They're like, this seems too good to be true, right? And then they're like, then 1 or 2 people executed on it, and then they come back and share like, look, I did it, it worked, kind of thing, right? So it's kind of like a weird concept people have a hard time digesting because they haven't ever done this in their lifetime.
No. Actually, it's good that you brought up those different kind of strategy that you have, and I see those channels there.
Yeah.
I don't know if this is the right time to ask, but is it possible, because I'm fairly new to this, if you can show me that one of the trade posted in one of the channel, how to interpret it and how to execute it. I'm still trying to make sense of that. There were a few of them, and said, okay, have some kind of for me it's more like in a code. So I'm trying to see like how to.
So we have videos in the meetup videos that you can go back in history.
Okay.
And we are sharing how to use the Tastyworks platform and how to execute and all that, and like how to execute it on the mobile phone. We've done it. Unfortunately, Tastyworks doesn't pay us for that, but we still go through like the demo of the Tastyworks platform, even though we try to go through the demo.
Yeah, I mean,
Yeah.
I can get there, but see what I'm saying is like when you post a trade there, how to even interpret in the sense that what exactly you're saying? What does it mean? You're saying that
Oh yeah, yeah, yeah. It's their pin, buddy. It's
Okay.
very simple. Here, look. Here, let me go back to the channel. Can you all see my screen still? Am I still sharing?
Mhm.
Okay, look. Like, so for example, here, core trades, right? Let's go back up, right? You see this pin thing right here?
Right. Yeah.
Go to pin. Okay, look. Okay, new trade means this is the first trade, not a hedge.
Yeah.
Adjustment, small, medium, high, catastrophic, out, expiry date, strike price,
Okay, that's helpful.
put. Like we're defining everything pretty much. And let me
Right.
jump to that message. It's right up here. The first message in the group.
Okay. Okay.
Yeah,
That
like what this means, so you can read it. And then how to read the screenshot as well, we have put it in the videos. So
Okay.
it's there out in the videos. You just have to browse through those. Yeah.
Okay. That makes more sense actually.
Yeah.
Yeah.
Yeah. Yep.
Cool. Thank you.
Yeah. Cool. But are we good with Neo? Can we end the Neo conversation? Are we good?
Yeah, I'm good.
Good, good. Fair enough. So end the recording.